Aloha students, and welcome to the lecture on Chapter 2. In Chapter 2, we're going to be looking at the accounting process. This is kind of a review of what you learned in Accounting 201. Basically, it's the steps in recording accounting transactions. So the first thing we look at, and I'm sure you're familiar with this is the accounting equation. And the accounting equation, as you remember, is your assets equals liabilities plus owner's equity. And as you can see, owner's equity can be further divided into investments by the owner, which is a increased owner's equity, withdrawals by the owner, which is a decrease to owner's equity, hence the minus here, and then revenues and gains increase owner's equity, expenses and losses decrease owner's equity. Looking at the accounting equation with respect to a corporation, assets and liabilities are the same, but rather than owner's equity, we call it stockholders' equity. And stockholders' equity is divided into two subsections. Paid in capital, that's the amount of funds or money that owners invest in the corporation in the form of stocks. And then retained earnings, which is the amount of income that a corporation does not pay out to its shareholders in the form of dividends. So the amount of earnings they keep within the corporation. That's why it's called retained earnings. So retained earnings can be further broken out into revenues and gains. Those are positives. They increase retained earnings. And expenses and losses. Those are negatives. They reduce retained earnings. And then dividends are what's paid out to shareholders. So that decreases retained earnings as well. Okay, so this is the accounting equation for a corporation. Okay, you remember the rules of debits and credits. So when do you debit an account and when do you credit an account? So here's our accounting equation, assets equal liabilities plus stockholders' equity or shareholders' equity. And that's broken out into T accounts. And for assets, remember that increases in assets are debits, decreases in assets are credits. So you remember the term debit simply means the left side of the T account. The term credit simply means the right side of a T account. So notice for all the accounts, the debits are on the left side, the credits are on the right side, but depending on what kind of an account it is, debits may be increases or decreases, and credits may be increases or decreases. So for assets again, increases in assets are debits, decreases in assets are credits. For stuff on the other side, on the right-hand side of our equation, it's switched around. Decreases are debits, increases are credits. So notice for liabilities, decreases are debits, increases are credits. And then for the shareholders' equity accounts, the paid in capital, decreases are debits, increases are credits, and likewise for retained earnings. But when we break out retained earnings into its components, expenses and losses reduce retained earnings, so the signs are reversed. So increases are debits, decreases are credits. Revenues and gains increase retained earnings, so they have the same sign as the retained earnings as a whole here. So decreases are debits, increases are credits. Yeah, so you've got to know these rules of debits and credits, they're called. So you should know, when do you debit increases, when do you credit, decreases, etc., etc. Okay, so you should know these rules for increasing or decreasing debits and credits. Down at the bottom down here mentions permanent accounts and temporary accounts. Temporary accounts are those accounts that we keep track of for a certain period of time, usually a year, and then at the end of that period of time, we wipe them out and start from zero again. So temporary accounts are the revenues and gains, expenses and losses. So we accumulate or keep track of our revenues, for example, to see how much revenues we have for a year. And then when we start the new year, we zero those out and start the new year with zero. So we can keep track for that one particular year. So temporary accounts we're only accumulating for a period of time, again, usually a year. Permanent accounts, on the other hand, we're keeping track of not only for a year, but for forever, basically, since the corporation has started. So these accounts, we don't zero out at the beginning of the year, and we just continue those accounts, assets, liabilities, paid in capital, and retained earnings accounts. We keep track of those on a permanent basis, so we never zero these out at the start of the new year. And you will get to this when we talk about closing accounts. Okay, I guess I can't move that. Okay, so here's the processing cycle for accounting. So we start off with source documents, whether they're invoices, receipts. So the paperwork are the source documents. We then analyze the transactions, and analyzing the transactions, as we'll see in a second, means which accounts are affected and does it increase or decrease that account. Then we record it in the general journal. Okay, the journal is just a chronological listing of all of our transactions as they occur. So chronological as they occur. We then transfer the information from the journal to the ledger, and that process is called posting. The ledger is a summary of all of the transactions from the journal. Remember, the journal was chronological. The ledger is organized by different accounts. So we're pulling information from the journal related to a specific account and posting it to the ledger for that account. So we're keeping track of all the transactions for each particular account. For example, cash. We look at all the cash transactions from the journal and we accumulate them in one place called the ledger. Okay, once we're done with the accounting period, we then prepare an unadjusted trial balance. So a trial balance is a listing of all of the balances in the ledger. So all the ledger accounts and the balance at the end of the accounting period. And the reason that we do a trial balance is to make sure that our debits equal our credits. Okay, once we have a trial balance, at the end of the accounting period, we need to make certain adjustments. Adjustments or adjusting entries basically are corrections of things that are not quite right in the financial statements, mainly due to timing differences or entries to make it easy to record. And we'll talk about adjusting entries later on in this chapter. So once we finish with recording and then posting, so remember, recording is in the journal, posting is in the ledger. So once we have all the adjusting entries put into the journal and then posted to the ledger, we then get an adjusted trial balance. An adjusted trial balance is a listing of all of the accounts and the balances after we make all of our adjusting entries. And again, the purpose of the adjusted trial balance is to make sure that our debits equal our credits. From the adjusted trial balance, we can then prepare financial statements. Excuse me, I'm not sure how to get rid of this bottom panel. Hold on. Oops, sorry. Oh, there we go. Okay, so after we do the financial statements, at the end of the year, then we, again, remember we wanted to close out our temporary accounts and make them zero because we're going to start the new year with zeros so that we can accumulate the totals for that year for certain accounts. So we close the temporary accounts, and closing temporary accounts means zeroing them out. Okay. Once we zero out the temporary accounts, we then prepare a post-closing trial balance. Post-closing trial balance is a listing of all of the accounts and the balances at the end of the year after we've done this closing process and made the closing entries. Again, the purpose of the post-closing trial balance is, again, to make sure that our debits equal our credits. Whoops. Okay. There we go. Okay, so again, this is the accounting cycle, all the different steps that we follow during the accounting period. So let's take a look at a specific transaction and how we do the accounting for it. So this case, July 1st, two people invested $30,000 each in a new business, Dress Right Clothing Corporation, and each of the two individuals was issued 3,000 shares of common stock. So this is a corporation. So corporations issue stock, common stock or preferred stock. So they issue stock. Okay. Remember, for every transaction, there are at least two accounts that are affected. So we have to look and see what exactly happened here. So the corporation acquired cash. Since two individuals each invested 30,000 cash each, the corporation has 60,000 of cash now. So the cash went up by 60,000. And the other thing that happened is common stock was given to the two individuals. So $60,000 of common stock was issued. So that common stock account increased by $60,000. So the journal entry that we make in the journal is going to look like this. We debit cash, and remember from your rules of debits and credits, cash is an asset. When assets go up, that's a debit. So this case, cash, the asset cash went up, so we debit cash, 60,000. And then the stockholders' equity account went up because now we had zero before, now we have 60,000 of common stock issued. And again, remembering from the rules of debits and credits, an increase in a shareholder's equity account is a credit. So we credit common stock 60,000. And the form of this journal entry, notice that the debits are listed first. The credits are indented so that we can readily identify that those are credits. Yeah, so we have a debit is 60,000 and a credit is 60,000. And remember, for every transaction, debits must equal the credits. And in this case, it does 60,000 each. Okay, so that was the posting, or that was the recording in the general journal. Taking a look at the general ledger, remember we said it was a accumulation by account of all the transactions related to that account. And the reason we use that T account format is because if you look here, we have columns in this general ledger for our debits and our credits. Again, debits are always the left side here of the T account. Credits are the right side of the T account. Okay, so rather than writing all this information down, the T account's kind of a shortcut method for describing what the debits and credits are. So here's how the posting process works. So here's the general journal with all of the transactions in chronological order. Here's a page from the general ledger. This is the cash account. So basically it's taking all of the cash transactions from the general journal and transferring or posting those to the general ledger. So the first one, oh, here's a cash. There's a debit to cash for 60,000. So remember, debit is the left side. So here's that $60,000 debit to cash. Oh, here's another cash. That's a debit for 40,000. Let's put that on the debit side, 40,000. Oh, here's a credit to cash, 24. So we put that on the credit side, 24,000 as a decrease. Here's a cash decrease or credited for 12,000. We put it on the credit side of our general ledger. So posting is just taking all of the transactions from the general journal and putting each amount into the proper general ledger page. The reason we accumulate all this is so that we can end up with a balance at the end of the period, and it's easier to find the balance if you're accumulating all of the similar types of transactions on a single page. So we know that we ended up the month with $68,500 in cash. Okay. So that's posting, transferring information from the journal to the ledger. Okay, so after we've finished recording all of the entries in the journal and then posting it to the ledger, here's the listing of all of our accounts and the balances. So we make sure we put the debit balances and the credit balances there. Here's that cash account that we saw in the previous slide. It had a $68,500 debit balance. So we do that for every account. We find the ending balance and put it on the unadjusted trial balance. And it proves that debits equals credits. Okay, and that's the whole purpose of a trial balance, is to show that debits equal credits. If the debits did not equal the credits, then we know, oh, we made a mistake someplace and we better go back and find it. Okay. So here's adjusting entries. Again, these are entries made at the end of the period to take care of timing differences mainly, and to make sure that the matching principle is met. Adjusting entries are probably one of the hardest concepts to get. It's not an easy concept, but there are three major types of adjusting entries: prepayments, accruals, and estimates. Prepayments are when a company receives cash or when they pay cash before the revenue or the expense is recognized. So for example, it's somebody paying ahead of time before the services are rendered. That's a prepayment. We can't record it as revenue until something is done, so the work is completed. But if there's a prepayment, the work has not yet been completed, so we have to adjust for that. An accrual, on the other hand, is the opposite of a prepayment. Cash is either received or paid, depending on which side of the transaction you're on, after the expense is recognized. So an example of this might be you sell something to somebody, so revenue is recognized when you sell it to them, but you're not going to get the cash until later on. That's an accrual. An example of that is an accounts payable. And then estimates, a lot of times, and we'll see some examples of this, accountants have to make estimates at the end of the month. And again, we'll get into that when we go through some examples. For prepaid expenses, notice that an example of this is somebody paying 6 months worth of rent in advance. So the company receiving this rent, or the company paying, let's say, this 6-month rent in advance, the expense doesn't occur until they've actually used the property that they're renting. So that occurs during that 6-month period of time, but they're paying all 6 months up front. So they're paying in advance, so that's called a prepaid expense. Okay, and a prepaid expense, as you can see, requires a decrease in an asset. And remember, decreases in assets are credits. And an increase in expenses. And you remember from the rules of debits and credits, increases in debits are, or increases in expenses are debits. Okay. For this whole area of adjusting entries, when we go through the homework, I think it'll be clearer. Depreciation is a special kind of adjusting entry. Depreciation, as we'll learn in a subsequent chapter, is spreading out the cost of property, plant, and equipment over its useful life. So if you buy a piece of equipment that will last 10 years, you're paying for it all at one time up front, but you're not going to expense it over, you will expense it, sorry, over the 10-year periods. You're spreading out the expense. Yeah. So here's an example, as you remember from Accounting 201, of how to calculate one type of depreciation called straight line depreciation. And again, we'll talk about this when we look at the homework. Okay, so here's an example of how to calculate straight line depreciation. So remember they had furniture and fixtures on that unadjusted trial balance for this dress right clothing of $12,000. So if we assume that there's no salvage value, and remember salvage value is how much will that asset be worth at the end of its life. So at the end of its life, it can't be used anymore for the purpose that it was purchased for, but it still has some value, whether scrap metal, for example, for a car that's no longer able to be used, parts. So there is some value, even though you can't use it anymore for its intended purpose, there's still some value at the end of its life. That's called a salvage value. And remember that that's an estimate. We have to estimate that in the beginning. Useful life is how long will that asset last? how long will we be able to use that asset? And again, at the beginning of the life, we don't know for sure how long it'll last, so we have to estimate that as well. So given this information, let's calculate the depreciation for the month. So depreciation on a straight line basis is your cost minus your salvage value divided by useful life. So it's the 12,000 cost minus 0 salvage value divided by 60 months, and you get $200 a month. That's the depreciation expense. So you can see the journal entry down here. We're debiting or increasing depreciation expense by the $200, and we're crediting a special kind of an account called accumulated depreciation furniture and fixtures. Just as an aside, this is a contra asset account. So it's almost like a negative asset account, since this account goes against or reduces our furniture and fixtures account. It's like a negative asset. So if you increase a negative asset, that's a credit here. Okay, but again, we'll go over that through the homework. So after you post it to the respective accounts in the general ledger, it'll look like this. So depreciation, we increased it by $200, and we increased the accumulated depreciation by $200, so that's a credit. So you see the depreciation expense is debited, accumulated depreciation's credited. Okay, unearned revenues is when a company receives cash before it provides the services or provides the products that it's selling to its customers. So they're getting money in advance. Okay. Getting money in advance, the adjusting entry is going to be a decrease in a liability and an increase in the revenue. And again, we'll go over this in more detail when we go through the homework. So don't, we won't go through the details of that right now. And accrued liabilities, just be aware, and again, we'll look at the details when we go through the homework. We're debiting an expense and crediting a liability. Okay, so because you got services, accrued liabilities occur when you got services or received a product before you paid for it. So you're going to pay later. And the reason it's a liability increases, now you owe money to the person providing you the service or the product. So that's an increase in a liability. It's a debt now. And an expense because you got some kind of service rendered to you. Okay. And that service was done now, so you record that expense now. Okay. Here's an example of a specific kind. It's a receivable in this case, where this tax preparer did a tax return, and they're going to get the cash later on. Okay, but again, we'll go through the details of that. Estimates. Whoops. As is indicated here, accountants often make estimates for future events. So examples of this might be depreciation, uncollectible accounts for accounts receivable, which we'll cover in more detail in subsequent chapters. And we have a homework assignment on this time. Okay, so here's the adjusted trial balance. And again, the adjusted trial balance is all the accounts, the balances at the end of the period, in this case, July 31st. And the reason, again, that we do this adjusted trial balance is to make sure our debits equal our credits. From the adjusted trial balance, that's what we use to prepare the financial statements. So here's the income statement. And you remember that what goes on the income statement is, or are, revenues and income, expenses and losses. We don't have any here, but so it's your revenues minus your expenses gives us net income. So that's the format of the income statement. All of these numbers come from the adjusted trial balance. Okay. Statement of comprehensive income. There's a few types of things that are kind of like special cases, and those go into what's called other comprehensive income. Those special items are not included in the calculation of net income, but they're shown separately. Okay, so just be aware of that general concept. Now we're going to talk more about other comprehensive income in a subsequent chapter. Okay, here's the balance sheet for this Dress Right Clothing Corporation. And you remember the balance sheet is at any particular point in time, so the end of the year, you list your assets. Again, these come from the adjusted trial balance. And the liabilities and shareholders' equity. And again, notice that the balance sheet is the summary of the accounting equation. Assets equals liabilities plus shareholders' equity. By the way, shareholders' equity and stockholders' equity are synonymous terms. They're used interchangeably. Okay. Statement of cash flows. We'll look at that in more detail at the end, near the end of the course. But statement of cash flows shows where cash comes from and where cash goes to. So it shows the ins and the outs of cash to show how much cash increased or decreased during the accounting period. Okay, so there's a special statement specifically for cash. Statement of shareholders' equity. For common stock, retained earnings for the basic categories of stockholders' equity. Shows beginning balance, the changes during the month in this case, and the ending balance at the end of the month. So it just shows the beginning balance, the changes during the period, and then the ending balance of the period for the different categories of stockholders or shareholders' equity. Okay, so that's a statement of shareholders' equity. Then you remember the closing process for revenues, expenses, and dividends. Let's step back. For revenues, we're going to zero those out. And the way we zero them out is we zero them against an account called income summary. So we're putting all the revenues into this account called income summary, making all the revenues zero. Then we put all the expenses into the income summary and zeroing these out. So the income summary, after you put all the revenues in there and after you put all the expenses in there, equals your net income. Okay. We then close out this income summary. We close it out by closing it against retained earnings, which we'll see when we do the homework. And dividends are also closed out against retained earnings. Okay, so these are the accounts that we close out or zero out at the end of the accounting period. Assets, liabilities, and the shareholders' equity accounts that are not these accounts here, those are permanent accounts, so we do not close those out. So the stuff on the balance sheet, we don't close. Stuff on the income statement, we do close. Okay. After we've done the closing entries, this is the post-closing trial balance. So notice that all the accounts that are on the post-closing trial balance are all balance sheet items. Notice they're all assets, they're all liabilities, or stockholders' equity accounts down here. Notice there's no revenues and there's no expenses on the post-closing trial balance because we've zeroed them all out. Okay, so what's left on the post-closing trial balance are only the permanent accounts. And again, we want to make sure debits equal credits, and that's why we do this post-closing trial balance. Don't worry so much about this conversion from cash to accrual. We're not really going to do the appendix. All this basically says is you can do a worksheet, and there's a certain format for that worksheet to make the process simpler for doing and recording the adjusting entries and recording the closing entries. So it's just a place where you can do all of those transactions in one place. But again, we're not going to really cover that in this class. Here's what it looks like: an unadjusted trial balance, the adjusting entries to get an adjusted trial balance, and from that you can make the two financial statements, income statement and balance sheet. Okay, so worksheet is just a mechanism for figuring out all of these things, but again, we're not required and we're not going to do it. Don't worry about the rest of these, except I just subsidiary ledger. A subsidiary ledger is a detail of a general ledger account. So in a general ledger, for example, there's an account called accounts receivable. But that accounts receivable account may be made up of many different individual accounts, because they may have 100 different customers with whom they have accounts receivable. You don't want to put all of that in the general ledger because that'll make it too bulky. So you have a separate record of the accounts receivable accounts. That way you don't have all the detail in the general ledger, you just have the total in there, and you have a separate ledger that has all the details. So several accounts have subsidiary ledgers, and again, that's where we keep track of all of the details and just have the total in the general ledger. Okay. Special journals are certain, rather than putting everything in the general journal, oftentimes we use special journals to record a particular kind of transaction. So an example of a special journal may be a cash disbursements journal. Cash disbursements journal is a journal where we keep track of all of our cash disbursements, sort of like a book register. So that way we can just then summarize that special journal and put the total for the month in the general journal. That way you don't have a whole bunch, too many transactions in the general journal. We can just have it one summary in there and have all the details in this other special journal kind of a thing. So sales journal is a special journal that records all credit sales, for example. Cash receipts journal is a journal that records all cash receipts, etc., etc. Okay, so that's chapter 2. The daily quiz question will be about my favorite food, and my favorite food is sushi. Okay, that's the lecture for chapter 2. Aloha.